Hello everyone and welcome to our second day of the Finance in Common Summit 2021. It is a pleasure to have you all with us, both here in Rome in beautiful Villa Aurelia and obviously online. Thank you for being here. Thank you all also for this very interesting opportunity. Yesterday the summit opened with a great audience response, so we're very happy. We've been hosting several sessions and we've given the floor to more than 100 high-level speakers. So it couldn't be better and we're very happy. So thank you as well to the World Federation of Development Finance Institutions and the International Development Finance Club, of course, but obviously thank you to Cassa Depositi and in partnership with the International Fund for Agricultural Development, the IFAD, for hosting this second edition of the Finance in Common. And please let me take a minute to say thank you also to all our partners that have supported and promoted the summit, making it possible. And thanks also for sharing the same vision that we all share in bringing this to all of you. So the aim of this summit, as we begin our session, is to set the new boundaries of the role of public development banks in the transition towards a fairer and more sustainable world. And today we'll start with 2 plenary sessions, followed by a series of thematic sessions, just to give you a full picture of what actually we want to convey. It will obviously also be the day of the Leaders' Dialogue, and we're very happy and excited about that. So thanks again. And now, without further delay, we'll start with the first plenary. The session will be focused on the presentation of the first global database of the public development banks and the development financing institutions, so the two institutions. The project began in 2017 in Beijing by the Institute of New Structural Economics at Peking University and has been developed in collaboration with the French Development Agency. So let me welcome the principal investigators of the database project. First, here with me, Regis Marodon, sustainable finance expert of the Agence Française de Développement. And thank you for being here. And I'd like to call on stage, virtually however, Jiajun, and I apologize if my pronunciation isn't very good, but the Deputy Dean of the Institute of New Structural Economics at Peking University. So thank you very much for being here, and we await, with anxious expectation your presentation.
Thank you very much, Alessandra.
Thank you.
So hello, Jiajun. Very happy to have you online in Beijing. And before you start the presentation, I would like to pay special tribute to you and to your team in Beijing. It has been many years of tremendous effort. And more than 100 research assistants have helped us, that are proficient in Arabic, in French, in Portuguese, in many languages, to get to the intermediate result that we have today, because we have, of course, more to deliver. But it's really a pleasure to be online with you today and to present to this very important gathering the result of our research. So please, Jiajun, I suggest you start with the presentation, and I will take over a little later. Jiajun, we don't hear you, so I think we have a small technical problem to solve here.
Can you hear me now?
Yes, we can hear you. So please, proceed.
Excellent. Yes. Well, thanks, Regis. So I'm very delighted to have the opportunity to launch the first global database on public development banks and development financing institutions in this Finance in Common Summit, together with my collaborator, Dr. Regis Marodon. Our presentation today has 4 parts. First, we start with the motivation behind building the first global database on PDBs and DFIs. Second, we will present the 5 qualification criteria that helps to answer the basic conceptual question of what are PDBs and DFIs. This helps to distinguish PDB and DFI from other similar institutional arrangements in order to build a reliable list of PDB and DFIs. Third, we will share with you some of the key findings based on the first-hand data collection to uncover the vast diversities within the PDB and DFI family. And finally, looking forward, we would like to share with you our future plan of the database building project and original academic research. Well, let's start with the motivation for building the first PDB and DFI database. Recently, the world is witnessing a renaissance of PDB and DFIs. At the international level, to fill the vast infrastructure financing gaps, China and other emerging economies have initiated the Asian Infrastructure Investment Bank and the BRICS New Development Bank. At the national level, both developed countries and developing countries have recently established or plan to establish PDB and DFIs to achieve social, economic, and environmental goals. For instance, the UK government established UK Infrastructure Bank this June, and the Ghana government has announced to create the National Development Bank of Ghana, which will be in operation very soon. Indeed, PDB and DFIs are potentially potent instruments for fixing market failures, incubating frontier market, and promoting economic structural transformation in a more equitable and sustainable manner. The time is ripe to unleash the full potential of DFIs and PDBs for achieving the sustainable development goals. However, in sharp contrast with the renaissance of PDB and DFIs in practice, there's lack of in-depth academic research on their roles, governance, and effectiveness. A major reason behind the positive research is lack of data. Few has systematically identified PDB and DFIs worldwide, let alone collecting the first-hand data on their operations and development outcomes. So to fill the gap, INSE has initiated this database project and then collaborated with AFD to provide this public good of database. So we have published a series of flagship reports to share the latest progress in the database building. Now let's move to the next part about the conceptual foundation of what are PDBs and DFIs. So to build a reliable list of PDB and DFI, we need to answer the fundamental question of what are the key features that distinguish PDB and DFIs from other institutional arrangements. So after very intensive internal discussion and consultation with experts and practitioners worldwide, we propose a set of 5 qualification criteria to capture the identity of PDB and DFIs. Only when an entity simultaneously meets all the 5 qualification criteria can it be qualified as a PDB and DFI. So the first criteria is being a standalone entity. This is a prerequisite, which helps to distinguish PDB and DFIs from government credit programs, trust funds, and special purpose vehicles. We operationalize this criteria by examining whether an entity has a separate legal status, dedicated personnel, separate financial statement, or whether it is not set up to accomplish short-term specific goals as SPVR. And criteria 2 and 3 takes a step further to highlight the core features of PDB and DFIs as financial institutions on both asset side and liability side. On the asset side, as shown in criteria 2, PDBs and DFIs need to use fund reflow seeking financial instrument rather than pure grants as their main products and services. So what do I mean by fund reflow seeking? It means that an entity needs to deploy financial instruments such as loans, equity investment, or guarantees, whose business model must permit some form of repayment, capital dividends, risk premium. These have to ensure financial discipline upon the client, and this will also help to distinguish PDB and DFIs from grant executing agencies, such as foundations. Yet seeking reflows does not necessarily mean that repayment have to cover all the borrowing costs. Such an emphasis on client financial discipline does not prevent PDB and DFI from extending soft loans in their portfolio to fix market failures. Then on the liability side, as shown in criteria 3, their funding sources need to go beyond periodic budgetary transfer from the government. As financial institutions, PDB and DFIs need to have financial liability on their balance sheet. So PDB and DFIs can rely on the government support to use market means to mobilize funding, such as rely on the sovereign creditworthiness to issue bonds on the capital market. This helps to distinguish PDB and DFIs from aid agencies, that primarily rely on budgetary transfer to sustain their operations. And finally, criteria 4 and 5 further highlight PDB and DFIs are development-oriented financial institutions initiated and steered by government. Criteria 4 highlights that unlike profit-maximizing commercial banks, PDB and DFIs have the official mandate to proactively pursue public policy objectives. Though in practice, state-owned commercial banks may sometimes undertake policy lending, these are not their proactive effort, but policy burden imposed by government. Furthermore, criteria 5 maintain that to ensure that PDB and DFIs are development-oriented, government need to play a steering role in setting their corporate strategies. The most straightforward operational indicator is for the government to act as a majority shareholder. Government steering can also be achieved with other means. For example, government can guarantee its bond issuance, government can provide low interest or interest-free loans, or provide preferential tax treatment. This criteria of government steering helps to distinguish PDB and DFIs from grassroots initiative in line with development goals, such as microfinance institutions. Now, I would like to hand it over to Dr. Regis Marodon to introduce the stylized facts of PDB and DFIs based on first-hand data collection. Regis, hand it over to you.
Thank you very much, Jiajun. Okay, so difficult task. Now we are going to dive and dig a bit into the figures, what the whole thing means for our coalition. Well, one sentence maybe with three striking figures. 527 development banks in 150 countries, accumulating close to 19 trillion US dollar in assets, directly contributing to at least 10% of world investment. I think this is a simple sentence establishing facts that were barely known even 2 years ago. So for studying development banks, with Jiajun and the team, one had to go back to the spirit of the Enlightenment. We were like, the ancient biologists trying to define plants and animals and have categories that would be meaningful to classify them, construct a rational typology. That's what we've been trying to do, and that you have now on the screen, once we have stabilized the definition for the perimeter of the development banks. It's not an easy task because even though they live in the very large financial universe, so they have their own ecosystem, each and every one of them, all the same, their characteristics were still very imprecise and quite variable. How can you classify, in fact, in common categories, institutions so different as the World Bank, the Cassa dei Depositi, or the Rwandan development banks that are with us also today? So our proposal is to organize in a typology of 4 dimensions. The first one is who is the owner of the bank. The second is where do they operate geographically. A second, how big are they? How big are the operations measured by the asset size? And finally, what do they aim at? What is the mandate, the official mandate that they are pursuing? And these 4 criteria crossed together permits a multidimensional vision and open the possibility of studying in a coherent way the performances of these development banks in aligning with the 2030 agenda, which is the hand purpose. So let's pay a short visit to each and every one of these dimensions. So the first one, also simplified, showed the 3 main types of ownership: multinational, subnational, and national banks, of course. Now, what you can see here is that multinational development banks are 47. That was a surprising figure for us, because everybody, of course, have in mind the World Bank, the regional banks, etc. But in fact, they are much more numerous. So it means that in many regions of the world, countries have decided to pool resources in one single institution and therefore, being supranational, create a very efficient sort of animal in its capacity to transfer funds at the local level with mutual guarantee from the member. Examples are numerous, but this looks like a very successful model. Some of the examples are the Development Bank of Latin America, the CAF, the Trade and Development Bank in East Africa, or the Black Sea Trade and Development Bank, and there are many, many others. Another striking point here is that subnational banks are very important. 1,100 are active. 111, sorry, are active. They are 21% of all the banks, and they are mostly voiceless, in fact, on the international scene. And given their crucial role in territories, there is probably something here also for the coalition of development banks. But of course, what you can see immediately is that the most common model are the national development banks. 70% of the total 369 establishments, they really are the key players in there. Well, these graphs are a bit complex. I mean, I refer you to the paper that we wrote together with Jiajun and Xinjun Hu, another researcher of the Beijing University, called Mapping 500 Plus Development Banks, where you can see all the details. But just here, 3 takeaways from this graphing representing the crossing of geographical scope with the ownership structure. The first one is that national banks concentrating on national issues are still the majority, but they are only 55%, both in numbers of size. Remember, they represent 70% of the banks. So national banks with a mixed mandate, mixed geographical mandates appear here. They are banks financing both their national economy and very active at the international level. They represent almost 30% of the assets, so it's also quite big and surprisingly big. Big animals also are sitting here, like the China Development Bank or the KfW, who are very important. And then multilateral banks, 11% of global assets. It's an interesting takeaway also when thinking about the global architecture of what can be really meaningful for getting to the 2030 agenda. Okay, sorry for the figure here, but this is a research that is based definitely on a database. What we've tried also is to identify banks by size of assets category, separating the mega banks, there are a few of them, from the very small institutions. And indeed, it is spectacular to measure how big are gigantic and how others are so small. The result is showing a very high concentration. 9 mega banks accounts for 65% of world assets of development banks. And if you add the 18 large banks, you reach to 84% of the assets. So the small and micro bank, the one with less than 20 billion of assets, are an impressive number of 365 institutions, but only 4% of the global assets. So this is also one of the takeaway for the summit today. The big should help the small to grow their expertise and financing, and I've been hearing that in many of the sessions also. We can also go through a type of mandates, as development banks usually define themselves as rural banks, SME banks, housing banks. We even have a category of Exim banks, 47 of them, very specific but important mandate directly connected to external trade and participating in many infrastructure projects abroad. Again here, the paper is very rich in analyzing that, but I will limit to maybe 3 comments. The first one is that most PDBs, whatever the mandates, have a particular focus and interest in SMEs. So it calls for an enhancement of the private-public partnership on that, as it is so important to support these actors that are everywhere the backbone of the economy. Now, another takeaway is that a vast majority, 183 of them, have a flexible mandate, meaning that they can adapt to any sector, any priority, depending on the demand of their government. And this is also an important feature when considering the alignment with the SDGs. Obviously, it calls for the international leadership of the fixed coalition that we are searching here, backed up with a more explicit mandate towards the SDGs, most probably. In future work with the University of Beijing, we intend to trace more precisely the role of compensating some market imperfections, but I don't enter into that right now. For the last sort of criteria that I want to present to you is the repartition by income level, the distribution by income level. According to the level of income of each country, you have again here some paradoxical remarks, interestingly enough, coming from the figures of the base. If 80% of high revenue countries have national development bank, only 62% from the 18 poorest country. Even more, it looks like the more the economy is developed, the more the national development banks are strong, the public national development banks are strong, which is a bit counterintuitive with what you could think about the market replacing the public in more advanced economies with well-functioning markets. They represent 20% of GDP in high-income economy and only 2% in low-income economy. And to me, it was very counterintuitive. I would have expected the reverse. So it's probably another interesting studying point as compared to the neoclassical mystery and still to be understood in a clearer way. Well, I mean, this was just to give you the appetite to read our paper with Jiajun, discover all the content and the richness of the base. So many thanks to your kind attention. Jiajun, I give you back the floor to trace the way forward. Please.
Great. So now I would like to share the future plan of our database building as well as the research plan. So to encourage more researchers to undertake original research on PDBs and DFIs, we have decided to make the database publicly available. We have devoted effort to build a data visualization website, which has been formally launched in this Finance in Common Summit. And here is a data visualization website where you can download the data for free. So be free to share the link with interested colleagues and stakeholders. Regarding the future plan of the database building project, we plan to focus on at least the following 3 aspects. First, we will update the PDB and DFI list on an annual basis by incorporating new ones and deleting those that has been commercialized or abolished. Second, we will use diverse data collection methodologies, including manual data collection, machine learning, and export verification to collect and triangulate the publicly available basic financial indicators, such as total asset, total equity, and net profit. Last but not least, we plan to conduct a questionnaire survey to collect thematically focused data, such as business models, financial regulation, corporate governance, to make the original research feasible. And to build a community of PDB and DFI researchers and practitioners, the Institute of New Structural Economics at Peking University has collaborated with AFD and the Research Academy of China Development Bank to launch an international research initiative of PDB and DFI working groups. So we have set up 5 thematically focused working groups with wide range participation of researchers worldwide. And this platform is open, so we hope that we can create synergies between this research initiative and the Finance in Common Summit Coalition to foster the policy dialogue and turn the research into policy action to unleash the full potential of PDBs and DFIs. So we are very much looking forward to your feedback on our pilot efforts to build this first global database on PDBs and DFIs. Here's our contact information. So you are most welcome to send your suggestions and comments. Thank you very much. Back over to you, Regis.
Okay, thank you very much, Jiajun. Well, I think we've been right on time, sharp 1 minute. So I don't know if we have time for any question. Maybe you can take one if you have one. No, if not, maybe I would give one precision. We already have started to collect figures for 2020. Of course, they're very incomplete. But what we can see is that the most probable information is that PDBs have made a tremendous contribution to the COVID recovery, and they may represent in 2020 even a higher figure than the one I quoted, most probably between 12 or even 13% of global investments. So this is also something that we are going to secure and present at the next FIX summit, hopefully. Yes, we have a question here, please.
Thank you. Good morning. Laurent Zilberberg, from Chairman of European Long-Term Investors Association. I have one question because I think that there is something lacking in the typology. Is the type of intervention of public development banks. I think you shall and we shall differentiate loans and equity. And this have a huge impact on both the structure of PDBs and also the impact on the economy.
Thank you very much for this important contribution. Well, of course, this is in the base. I mean, for the sake of the presentation, we had to sort of simplify and go straight to the point. But definitely, in the base, we separate development banks from investment funds, even from guarantee funds, and we trace also the instruments that the bank are using. It's not in such a secured state that we can publish it now, but yes, we have that on the screen. Thank you. Okay, so I propose to close the session. Thank you very much. I think we are expected in plenary session in the main room. Thank you again, and let's continue with the finance in common.